The Federal Reserve System, or simply the Fed, is the central banking system of the United States of America. Made of the 12 Federal Reserve banks, it has three main roles: promote maximum employment, stable prices, and moderate interest rates. We will focus on the last one, and in particular on Fed policy to control the federal funds rate. Depository institutions require a certain level of reserve balances determined on outstanding assets and liabilities. The FFR is the interest rate at which depository institutions lend reserve balances. Such interest rate is negotiated between the institutions. The weighted average of all such transactions is the effective FFR. The Federal Open Market Committee meets 8 times a year and decides a target for the FFR, which is a 25 bps range. For a basic understanding of the mechanism by which Fed controls FFR, when they wish to decrease rates, they increase the supply of money by buying government securities. Conversely, when they wish to increase rates, they decrease the supply of money by selling securities. By looking at the historical graph, we see that the effective FFR stayed between the range decided by the Federal Open Market Committee. However, the mechanism to control the effective FFR is more complicated, and different tools are used by the Fed.
To achieve the 25 bps range, the Fed relies on IOER, the interest rate it pays on excess reserves, and the overnight RRP, the overnight reverse repo facility. IOER, in green, is set by the Board of Governors and is the main tool that the Fed uses to move the FF rate within the target range. It is the rate of interest paid to depository institutions for their required and excess balances held overnight at the Fed. In theory, no bank that can earn interest at the Fed should be willing to lend below IOER. However, in practice, the FFR currently trades below IOER. The Fed Overnight RRP facility, in purple, is a supplementary tool to prevent the EFFR from trading below the bottom of the 25 bps target range. Since the Fed introduced overnight RRP in 2013, it has served as a relatively firm floor for overnight Treasury GC repo. The Fed also publishes another broad overnight unsecured bank borrowing rate, the OBFR, Overnight Bank Funding Rate, which consists of overnight FF and certain euro-dollar transactions.
Let's now see the main actors of the FF market. In the lending side, 95% of the activity is made by Federal Home Loan Banks, a system of 11 independent regional cooperative banks providing loans to support mortgage lending. Their core funding source is issuing overnight discount notes. The excess cash is used to invest in the FF market. This allows to earn the highest rate of return and the earliest return of cash. Moreover, the greater the FF discount note spread, the greater the FF market volume. In the borrowing side, historically, we have seen a prevalence of foreign banks attracted by the IOER-FF arbitrage, since they are not subjected to fees nor to Fed leverage ratio requirements. However, since the IOER-FF spread has narrowed, foreign banks are decreasing their borrowing activities, giving space to domestic banks willing to borrow for regulatory or true liquidity needs.
The Fed's current toolkit is only necessary because of the large amount of bank reserves currently in the system and which has grown throughout the years. In an abundant reserve framework, there is a limited competition for reserves because they are plentiful by design. This has kept the effective Fed funds rate below IOER and ensured that banks have been relatively flush with cash. This surplus of reserves came about during the financial crisis when the Fed initiated crisis lending programs and engaged in large-scale asset purchase programs. Reserve increases were initially concentrated at foreign and large domestic banks. The Fed pre-crisis regime relied on reserve scarcity, and the Fed needed to add or drain the appropriate amount of reserves in order to hit their Fed funds target rate. This regime relied on the Fed accurately forecasting supply and demand of reserves that were influenced by private bank required reserve and liquidity needs, as well as other autonomous factors that included currency in circulation, the Treasury General Account, and the foreign repo pool. If the Fed chooses to move back to their pre-crisis monetary policy operating framework, They will again need to accurately forecast bank reserve demand and other autonomous factor changes. This will likely be more challenging compared to the pre-crisis regime because of bank regulatory changes and autonomous factors that have become larger and more volatile.